So here's the thing that people don't know, and I didn't know this either until this book exposed this. The FDIC insurance does not protect everyone at the same time. It's the same thing with home insurance carriers, car insurance carriers. The carriers don't bet on everyone getting into a car accident on the same day, but they only have enough to pay out like 7% of all insured deposits.
Welcome back to The Broke Billionaires, where we document our daily struggles in building wealth while raising a young family. Join us as we talk creative wealth building for everyday people and couples that are struggling in a down economy. I'm Lauren.
And I'm Joshua Masari, and we'll be your hosts.
Happy Tuesday.
Happy Tuesday.
We can do a proper cheers tonight because I found a non-alcoholic champagne that I'm drinking. Prosecco, I guess. So,
all right, let's do it.
Cheers to another night. Oh, that's a nice clink.
Nice. Been a while since we've done that.
It has been a while. It tastes so much like champagne. It's kind of unreal. What are we talking about tonight?
Lots of fun stuff.
Lots of fun stuff. Okay. Should we dive right in?
Yeah, let's get into it.
Okay, let's go right to it. Let's see. Let's start with our updates. So we are talking to possible sellers and planting seeds for future deals right now. We want to be the first ones that people call before they decide to hire a realtor. That's kind of been our focus when we've talked about the postcards that we've sent out in the past. Our hope is that by doing that and hopefully getting to people being proactive with it, that they have those sitting on their fridge and they will call us before.
Let's be honest, nobody's going to put it on their fridge.
That's true. It's a family photo of us. That would be a little weird. Maybe have it in their junk drawer laying around and they're like, hey, didn't we get something from that couple, that cute family that wants to buy our house maybe? Right?
Yeah, that works.
That works. So that's our hope, is that someone would think of that before they decide to call a realtor. And we're hoping that we have kind of some different angles we're trying to work with this, but will you talk a little bit more about that?
Yeah, and it's not just the marketing. I mean, just talking to people around town. You're always talking to people down in the neighborhood we want to ultimately be in, kind of building those relationships, kind of planting seeds that we're looking to be down there. Just the other day, I was working on the house, the current project we're finishing up, and one of the neighbors that I'd never seen before, it was an elderly woman, and she was walking by and started talking. I had my headphones in, the saw going, so I shut everything down and pulled my earphones out, and she was talking about how she loved the color of the house. And
the unpainted house.
The unpainted house. And the material, it's this James Hardy siding that we use, and it's like a kind of a yellowy color, which is just a material color.
It doesn't even look like paint, but
it's funny because
maybe far away.
We've gotten that comment before when we were doing other houses with the same thing, but she's like, "Oh, I love this color. It's so beautiful." And then I had to explain to her that it's just the material color and it's going to be black, so definitely not yellow. Yeah. But we kind of started talking, and she'd been in the neighborhood since I think her and her husband bought this house when they were pretty young, and it's the same layout as this one that we're doing, and they were the second owners. They bought it, I think, 2 years after it was built as a foreclosure, and had 6 kids and have lived in it, and now they're all gone. And she was talking about possibly selling, or she wanted to sell, but I guess her daughter moved back in and is finishing up whatever she's doing with work and getting ready to retire, and then she's moving out of state. So basically, I was just kind of planting the seed, like, hey, when you're ready to sell, let us know, because we're going to be looking for another house. So before you do anything, give us a call.
Yeah.
kind of told her what we did with the other one and how we did a seller finance, and we're paying the sellers interest every month, and they're making money on that. And she was kind of like intrigued by that. So
Yeah,
who knows?
she was.
Maybe it'll be another opportunity for us down the road and be able to help somebody out in their situation too. So
It's like my little motto I have, ABC, always be connecting.
I always thought ABC was always be closing.
It is, but I like connecting better.
And
I'm much more of a connector than a closer.
And then I come in and close it.
There you go.
All right.
ABC works for both of us.
Yeah, there you go.
What else? We officially listed this house for rent, the current project that we've been working on. So we are getting ready to do an open house on that
yes.
in the coming weeks.
And
which is a little unconventional to do open houses for rentals.
Yeah, I feel like people don't do that for rentals, and we've always done that on our rentals.
It's honestly just more convenient to just have one time that people can come by to look at houses than having to schedule a bunch
more
of
convenient,
showings.
More convenient for us.
Yeah. Well,
because we just open it up and just tell everybody when to show up.
Yeah, exactly.
But we've had a lot of, it's not completed yet. We're trying to get this done, but
so close.
Threw it up to see if there was any interest, and there is a lot of interest. So now we're going to schedule, we put this on Zillow because we were originally, we are planning on doing it as a furnished rental. So we were looking at it through those avenues, but since we were kind of at the end of the line here and ready to get this thing rented, we usually do Zillow at that point just to get extra leads. But we've had a lot of people interested in renting it long term. They want it for 12 months or 24 months.
That's been all the inquiries we've gotten, right?
Yeah. Well, on Zillow anyway.
Yeah.
But they all want like 12 months with a renewal option. So, and most of them want it unfurnished too, which it wasn't what we were planning on doing, but we haven't fully furnished it yet. So we're open to that.
What else?
Well, I would say our financial outlook is getting better.
It's like, is it?
Yeah, it is, because these properties are stabilizing. We've got rents that are starting to come in. We're not bleeding as much each month.
We've slowed the bleeding.
The bleeding is slowing.
Okay.
So things are starting to stabilize. Once this current project is completed and we have a renter in there, that's obviously going to be a big weight off our backs.
Really helpful.
Once that property is stabilized, because not only will it be paying for itself and covering the carrying costs, but then we'll be able to stabilize it and prepare to refinance out of the loans that we're in. So that'll be nice to start getting that set up and moving towards that. So that's good. Apartment in Texas keeps getting, I feel like each week we've got a new applicant coming in and getting approved and moving in. I think there's a family that moves in tomorrow, actually. So that's good. It's slowly but surely filling up. So that property is starting to stabilize. And then this is kind of a weird one. So there's a duplex in South Carolina that we're selling. I've had that property for 7 years, I think. Was going to wait until the summertime to sell it, put some money into it, and then sell it in the summer, but decided to just sell it as is. Had an offer that made sense to not have to put money into it from another investor. Losing a little money not losing money on the property, but losing money on what we could get if we waited and put a little money into it. But there's tenants in there now, and we'd have to clear the tenants out, and it'd be a lot of trouble. And we also need to raise capital right now because there's another property that needs to be renovated. So it just made sense to just sell it as is with the tenants in place and raise the capital to put into other deals. So that was supposed to close the other day, but it didn't because the closing attorney wasn't ready on the title work, which is typical. They wait till the last minute to figure out there's a problem.
Yeah. So
this one was kind of weird because the property, I think, was acquired in like 2017. Yeah, I believe 2017. And in 2018, I remember getting a letter from the counties that there was 2 counties that had hired a survey company to reestablish the county lines.
Oh, that was
Basically,
this property?
yeah. So basically, what happened was the property was in Anderson County, all Anderson County when I first closed on it. Then they reestablished the county line, and the other county, which is Abbeville County, ran through a portion of the property, and actually it looks like a corner of the house, like a couple feet of the house.
I thought it was just the backyard.
I thought so too, but when I looked at the map the
okay.
other day, it's actually like, according to the map that they have, shows it like cuts off a little corner of the house.
Interesting. Okay.
So there's actually 2 tax bills on that property because there's 2 counties that it's in their jurisdiction. So the second one, the Abbeville one, it's like $13 a year or something. It's really dumb. I didn't even know about it when it first happened because
wasn't it like delinquent or something?
yeah, because
initially?
I got it was
They never
delinquent,
told
and
you.
they were foreclosing on the property. I was
Sorry,
like, what?
over like $13.
I'm like, this property's not even in this county. What are you talking
Yeah.
about? And then I come to, I mean, I probably got the letter and I didn't recognize it. I'm like, I don't have a property in that county. What is
Right.
this for? I thought it was just junk. And lo and behold, they moved the county line over
So
that
crazy.
that property is included.
That.
So they couldn't really foreclose on the entire property.
Well, no.
So they would have gotten a piece of property that doesn't have a house on. Like, I could have just not paid it and nothing ever would have happened because they can't do anything. But I mean, I guess they could have sold that corner of the property to somebody. I don't know.
No,
But
it has a piece of house on it.
anyway, I had to pay I ended up having to pay it all because me not knowing about it didn't suffice. And so they said, you can lose your property or you can just pay the whatever it was at that point. It was like $150, all the extra fees. So I paid that. And anyway, this attorney, I had told them there were 2 tax bills. They knew it and they didn't do anything about it. I don't know what happened. So at the last minute, they're like, oh, there's 2 property tax bills. I'm like, yeah, I told you that weeks ago. Why didn't you not prepare that based on that information I gave you? So anyway, the attorney advised the seller to get a survey, which ended up pushing the closing back a couple weeks. So now we're looking at closing, I think, end of next week. So it was a 2-week extension. Hopefully they get it all figured out and that closes, and then we can start renovations on the other property that is waiting right now.
Mm-hmm.
So that's fun. But yeah, I mean, things are starting to look up. I think things are getting better.
Okay. And then let's give an update about our lovely roof situation on the other property.
Oh yeah, that's fun.
This roof.
So we have, so insurance in really everywhere is getting out of hand. But California especially, there's a lot of carriers pulling out and just leaving California and not writing policies. So they're looking for reasons not to renew policy. I mean, look at the fire, like how many insurance companies didn't renew right before the fires because of fires. And over the last year, it's been happening for the last couple of years. It's not, it wasn't like it was just before the fire, but they're just leaving the state, and fires are a big reason for that. So we have this property that we bought in 2020, and it has a cedar shake roof, and they don't like cedar shake roofs because it's fuel for fires. The roof is not that old. It's only 20 years old. And a couple of years ago, we did a restoration on it. So I think we spent like $4,200 on a restoration. And they even said the roof wasn't in that bad a shape, but they replaced some shingles and cleaned it real well. And then put like a UV protectant, fire retardant chemical on it so that it wouldn't catch fire. And got a 5-year warranty on it. So it's still under warranty. And the insurance carrier that we have currently sent us a non-renewal letter because of the cedar shake roof. said, you need to put a new roof on or we're not going to insure your property. Even though it's under warranty, like the roof is still under warranty.
So annoying.
They just won't do it. So
it's crazy.
Now we're trying to figure out how we're going to get this roof done before the insurance renews.
Before we don't have insurance on the house.
Yeah. Because, so you can get insurance. There are insurance companies that will do it.
Yeah.
I did get a quote, and it's called you have to get a non-admitted carrier, which means it's an insurance carrier that's not admitted for insurance in the state of California. So it's basically an out-of-state carrier. They'll insure it. They're just not admitted. I don't really know what that means, whether they're admitted or not. I don't know.
Yeah, I've never heard of that before.
I don't exactly know what that means. I mean, I know what it means, but I don't know what the implications of it are. But it's really expensive. So our policy currently is, I think, $2,200 a year. And the quote that I got from the non-admitted carrier, which will insure the roof as is, it was over $10,000 a month, or over $10,000 a year. Yeah. So that's crazy.
Yeah.
It's almost as much as the taxes, which are also crazy.
Yeah.
So trying to figure that whole situation out. Waiting for quotes to come back on the roof because we don't know how much it costs, but it's a very large property. A lot of roof square footage, a lot of peaks and valleys, and I'm sure it's not going to be a fun one.
No, it never is. Kind of reminds me of that sermon I was listening to a couple days ago. And one of the things they said multiple times was that there are things you cannot learn in comfort.
We are definitely not comfortable right now. We are learning a lot.
We are learning so much.
Oof.
It's good, huh? It's a good, yeah. Well, we'll just hope we're learning a lot right now. I'm ready to be done learning. Right? Are you done learning?
I feel like we know.
While?
Yes, I think we've learned enough.
Okay. I think we're good with our learning for a little bit.
Just a quick disclaimer. The information shared on this podcast is for informational purposes only and should not be considered as financial, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Your individual circumstances may differ and require specific strategies not discussed here. Now, let's get back to the show.
All right. So tonight we are talking about inflation and what really causes it. And you have been reading a book that was recommended to us from Nick Hoyman, who was on episode 14. We interviewed him. The Creature from Jekyll Island. Is that what it's called?
Yes.
Okay. So I have not read it. You've been reading it. Are you listening to it while you're working on the house?
Yeah.
Yeah. You don't sit down and read.
No, I do audiobooks. I can't do it.
He loves to do audiobooks. I need to physically read, which is why I don't read right now, because it's a little tricky to do that with 3 young kids. But you're working on the house and able to pop in those headphones and listen to a lot. So tell us.
Yeah, so this is a very interesting book, and anybody that wants to know anything about money and the federal, how money works, how our system, our banking system works, and what the root cause of inflation is in more of a detailed, easy to understand explanation. This book is phenomenal. I mean, I think everybody should read it. I think everybody should have this backing because they don't teach you this in school. This is not something that you're going to learn in school. This is not something that the government necessarily wants you to know about. It really exposes.
Who is the person that wrote it? Like, what is his background?
I don't know. It's G. Edward Griffin, and I'm not sure what his background is. I don't know if he's just an author or if he's a journalist. I don't know, but there was a lot of, I can't remember at the beginning. I mean, took him several years to do all the research and do everything. And he pulled a lot of, there's other books that have gone into this and done a lot of the research. Because I know he said, without all these other books and previous authors that had done this research, this would have taken me 15 years to figure everything out. But he was able to do it in a few because of all the research that had already been done and kind of pulling everything together.
Piling it all together. Okay.
Yeah. So, but yeah, this is a really good book. We'll put it in the show notes, and it's a long book, but it's a really good read and gives you a really good understanding of how the system works.
Okay.
But basically, the big takeaway from this, I mean, there's several takeaways, but the big one is what really causes inflation. And the real cause of inflation happens when a government decides to put more money into circulation to fix a problem. And we always hear about
meaning like printing money.
Yeah, so you always hear the government, they're printing money, and that's what causes inflation.
Which you hear people say, like, why can't they just print more money all the time?
And they can, and they do all the time. And that is why we are in such a high inflation period right now. I think this is really pertinent today because the last few years, we've been in such a high inflation environment. This is where this comes from. Mm-hmm. So it really boils down to, and it's not just the U.S., it's all governments do this, and they all just, it's been going on for a very long time. Really since we abandoned the gold standard back in 1977, I believe, or 76. So that once they went away from the gold standard, that point they could just start making money and printing money out of thin air.
The gold standard meaning that it had to be backed by gold.
Right. So they had to have the gold
physically.
You have so you got $1 of gold and $1 in circulation, so it's backed by gold. I don't know if it was an actual 1-to-1 dollar ratio, but they had to have, you wanted to print more money, you had to get more gold and be holding more gold in the reserve to back that. So, so anyway, the reason they print money is to send, it's to fix problems, really. And
I could use some printed money to fix something.
It's to fix problems that they need to throw money at that they don't have money to throw at. The government operates at a loss every year. Mm-hmm. So when there's a big problem that needs to be fixed with money, where are they going to get extra money? They're already in the hole every year. They're already not making enough money.
Bigger.
So, right. But still, where do you get the money to make that debt bigger? Where does the money come from? So basically, they print money and fix the problem. So you want to send money for a war. You want to send money to another country to aid another country. You got large government debts that needed to be refinanced, or more money needs to be lent to another country, or something of that nature. And so that money comes from bailouts. Mm-hmm. We heard a lot about the bailouts, and during the Great Recession that we had. So all of the bailout money, all that money, you hear these big, just, billions and billions of dollars getting thrown to this bank or that company or this or whatever. That's all coming from just money out of thin air that's being printed. And that's where inflation comes from. So basically, and who pays for this? So it's the taxpayers that are paying for it, but it's not being paid for with taxes. They're not raising taxes on us to pay for this bailout or pay for this money that comes out. Right. Okay. It's we're paying for it in inflation. Okay. So what happens is when you print more money, there's more money in circulation, and it's not backed by anything. It's just money out of thin air. What you're essentially doing is you're devaluing the currency that's in circulation. Okay. So your dollar is not worth $1 anymore. It's worth however much they printed, that much less. And so now it takes more of your dollars to buy the same goods and services. And so because of that, you're using more money to fund that devaluation. And that's how they're making it up, is the American people are paying for it in inflation. So it's kind of a backdoor, tricky way that the government taxes everybody and pays for all this funding, is
not actually giving you a higher tax
bill. Right. It's through inflation. So it's kind of hit. And then they turn around and they blame inflation on, COVID or supply chain and all these different factors, which don't actually matter. It's not where inflation. There are some things like, the the eggs are expensive right now.
Bird flu.
So that's, these chickens are being killed off, and that's a supply and demand thing. But really, the bulk of it is the supply and demand or the supply of money itself
Okay.
that devalues what the dollar's worth and causes that inflation.
Interesting.
Yeah. So
did you know that before reading this?
no, not in this depth. It was always like, they're printing money that causes inflation. But I didn't. This actually goes into. I mean, it's a long book, so it goes pretty deep into these different, aspects of it and how it actually causes it.
Okay.
So I've never really dove in and understood it this well.
Okay.
So basically, when the government puts more money into circulation, it dilutes the value of the dollar. So it's just like a company, like a stock of a company. So if a company, let's say a company has 1 million shares valued at $1 per share, and they need to raise capital they need to buy some equipment or new building, or maybe they've got a loan that's due that they need to pay off, or whatever it may be, or they're in trouble, whatever it is. So that company can issue more stock. And let's say they issue another 300,000 shares to sell and raise capital. So this is called an equity dilution, because you're diluting the value of the shares that are currently outstanding. So all the shareholders that had, the $1 per share out of the 1 million shares. So all those $1 per share shareholders, that $1 it's not worth $1 anymore, because you just put another 300,000 shares out there. The company, the intrinsic value of the company is still only $1 million. It doesn't change the value of the company.
Okay.
You just got more shares. So you're taking $1 million. Originally, you had $1 million divided by 1 million shares. It's $1 per share.
Right.
Now you've got $1 million company divided by 1.3 million shares. So now it's worth less. So then your shares come out to about 77 cents.
Okay.
So all the shareholders out there that were already holding $1 share, their share just dropped in value by 23 cents for nothing that they did wrong. Not because the company is losing more money.
Yeah.
Because the company decided to print money, basically.
Okay.
And that diluted their share. And so now their share is worth less because of that extra money that was just printed.
Okay.
So it's the same concept with the economy, with the money in circulation. You're basically diluting the value of the dollar. So the gold standard was abandoned. 1971. I think it said 77. So
yeah,
the gold standard was actually abandoned in 1971. So this is interesting. The government still has over 8,000 tons of gold in reserves. So
then why don't they back it?
So because it's not nearly enough to back, it would be a small fraction. But the reason that we still have gold is because gold is a very stable asset, and it gives the government credibility that they actually have something that's worth value, that actually has intrinsic value. We're not just printing money, and the government has nothing that's not worth anything, right? So it just gives the government. It gives the US dollar some credibility because it's backed by the government, and the government has all those gold they're sitting on.
Okay.
So it does still, in a roundabout way, I guess it's backed by gold because it's backed by the government, which has gold in the bank type of thing. So, so it does.
Just not as strongly backed.
It's not directly backed. Like the actual currency is not directly backed. So that's what we've gone away from. But that's kind of what gives not only the government but also the economy stability, because gold is very, very stable because the intrinsic value of gold doesn't change.
Okay.
It may fluctuate in how much it costs to buy that gold, because as the US dollar is devalued from all this money being printed, it takes more dollars to buy that same brick of gold.
Right.
But the brick of gold is still worth the same value. It has the same value.
Okay.
Yeah. This was kind of an interesting thing. So they said that in this book that there was in not New York, no, I think it was in England. There's a restaurant, and it was like this is like 1901 or whatever.
Mm-hmm.
It was 1 ounce of gold to pay for this fancy dinner at this restaurant.
Okay.
And today, that same restaurant, 1 ounce of gold still buys the same dinner at that restaurant.
A true ounce of gold. You walk in and with an ounce of gold.
Yeah, I don't know if it actually will take gold, but the value, whatever gold is valued at, trading at that time, like during 130 years ago, it's or 125 years ago, it's the same value today in terms of what you're getting in return. So it hasn't. Inflation, even though it may cost more, gold also costs more because of all the devaluation of all the currencies. So the actual intrinsic value, what it costs to make that meal and serve that meal, still translates to the value of 1 ounce of gold.
That's kind of like wild, actually.
So if you think about it, it's almost like inflation doesn't actually occur. It's just the devaluation of these currencies that cause an imaginary inflation. But when you think about it, the intrinsic value doesn't actually change.
Do you think people are walking around with gold? Like, how many people do you think own gold?
I know people
did it say about that?
The largest, well, the U.S. is the largest, has the largest stockpile of gold, but
like personal.
But governments have a lot of money in gold because that's what gives them the credibility.
Okay.
But there's people that invest in it. Yeah, you can invest in it and you put it in a safe and
you have gold bricks in a safe.
I'm sure there are, but you put it in a bank. You put it in a, what is that? A lockbox.
Yeah.
Yeah. Or there's also companies you can buy gold from and it sits in there.
They hold it for you, kind of. Okay.
Yeah. So, but yeah, because the value of gold has never changed over the last, if you think about it, it goes way, way back. There's always been a demand for gold. That's always been pretty constant in terms of the demand.
So what does a brick of gold go for?
Now, I don't know. I think it's like $200,000 or something.
For one brick?
Yeah.
Wow. Okay.
So gold is a constant, and that's why it's always been. So they say that the reason it's always been gold and we haven't changed anything else, because there's still silver, there's other things, but we just haven't found anything that's better than gold because the supply and the demand balances each other out, and it's a precious metal. It's got a lot of value in terms of what you can do with it, and we've just never found anything better. So that's why it's always been a kind of a go-to and probably always will be until something better comes along.
How secure do you think that is?
Holding on to gold?
Yeah.
Well, if it's in a safe that's secure, it's putting it under your mattress is probably not the greatest idea. Especially
I guess it's no different than people who do hold on to just like physical cash under their mattresses, kind of.
Yeah, but I don't think people really do that anymore.
No, I feel like people still do that.
Really?
Yeah. Especially an older generation.
Well, I guess when I was saving up for your ring,
you for sure had cash like your.
It was not under my mattress, but it was in my sock drawer. But I had it in envelopes like taped up underneath inside the dresser, so it would have been really hard for somebody to find it. But
I guess
that
brick of gold is a lot harder to hide than dollars.
I'm pretty sure it was like a $5 dresser off of Craigslist I got, but that dresser, if anybody stole my $5 dresser, like it would have been a jackpot. Yeah, it was.
It's like when we watch those like house shows where they're going through like furniture that's left and they find random things like that.
Yeah,
it is actually. I feel like it's always random hiding spots in dressers or
That would have been a come up for somebody if they had stole my $5 Craigslist dresser.
I'm glad no one stole your $5 Craigslist dresser.
Yeah.
Oh my goodness. Okay, so people are not just physically hiding gold in their homes for the most part that you know of.
That I know of.
Yeah. Okay. Hey guys, if you're finding value or just want to follow along on our journey, make sure to hit that like button and subscribe. That would help us tremendously. You can also follow us on Instagram @TheBrokeMillionaires and be sure to share with your friends. Now, let's get back to the show. So would you say putting money into gold is a good idea? Like if someone is trying to figure out what to do with an investment, should they buy a brick of gold?
Yeah. So gold is very stable. So it is a good idea to put money into gold, especially during a high inflation period, like we've been seeing in the last few years. The reason it's such a safe haven for investors during high inflation periods is because if you put $100 into gold and there's a high inflation, government's printing money like crazy and devaluing the dollar. Let's say it's $100 in gold, and let's just say that over the next few years the dollar devalues and is not as valuable as it was, but that gold still has that same intrinsic value. So it's going to take more dollars now to buy that $100 brick of gold than it did a few years ago. Okay. So let's say after inflation takes place, it's now, that's that $100 worth of gold, or $100 gold, let's just call it an ounce, okay, is now, it takes $130 to buy that same ounce of gold. So by putting your money into gold during that time, you just made $30 because the dollar devalued itself. So if you had just kept your $100 in cash and put it in the bank, it would now be worth less than it was because it's devalued. So that, that gold is that standard, that constant. So now that ounce of gold, instead of costing $100, is going to cost you $130. So really your $100, if you just kept it in cash, is probably worth, well, actually, I think it's similar to our example from earlier. So it would be worth $77. So your $100 is only worth $77 in terms of how far it can go or how much gold it can buy compared to before that inflation occurred.
I can tell you how far it goes. It goes about 2 bags of groceries is how far it goes.
Yeah, they should actually, maybe we should switch to the instead of the gold standard, it should be like the egg standard.
Yeah, seriously. How many eggs can you buy?
Yeah.
How many, man, I remember. Okay. Yeah. I'll just go off on a tangent of that. So I won't go in. I'll stop myself before I get too far ahead.
Yeah. So gold is definitely a safe place to put money, especially when there's a lot of inflation going on, a lot of money being printed, okay, because you're going to make money on it. Not in terms like the actual value of the gold doesn't go up, but the money it takes to buy it does. So when you cash it back out, you're getting a lot more dollars back because of the devaluation of that currency during that time. So it's always going to be a safe place to put your money, and you're not, like, if you look at all the course of history, like you've never lost money in gold. Gold, it goes up and down a little bit, but it's really, really stable compared to a lot of other assets. So it's a very, very stable place to put your money.
What about land? Does the book talk at all about purchasing land, especially during like a high inflation period? Like, is that a good place to?
Yeah. So land is also a really, really good place to park your money, especially during high inflation periods, because it's the same concept. You have a physical asset that has an intrinsic value. Somebody has to have a home, so people are always going to need places to go. There's always going to be a value to land. And, even though it goes up and down based on demand, it still has that intrinsic value. And if you put it in land during a high inflation period, it's going to do the same thing. So as the dollar devalues, the intrinsic value of that land is going to go up compared to what the dollar is worth. So, same thing, $100 in land, and during a high inflation period, it may be worth $130 after that period. So, whereas again, cash would only be worth $77. So you're better off putting into land than you are with cash. Now, with land, it's a little different than gold because it does have more fluctuation on demand. So this is almost more geographical. Like, I would say it in different parts of the country or the world, it's going to have different effects. So, okay, here in California, it's a high appreciation market. So because there's a lot of demand, in a down economy, we don't really see a huge, obviously during 2008, that was a different story. But, right, we, in the last few years, even though the market has slowed down, we haven't seen prices really come down. And I think a lot of that is, one, there's still a lot of demand. Even though there's not as many houses selling right now, there's still demand. And as the value of the dollar is decreasing because of all this money being printed, it's raising the price of land because it takes more dollars to buy that same piece of land because that land still has the same intrinsic value for someone to live in. So it's not that prices of housing is going up so much. It's that the value of the dollar is going down so much.
Okay.
And so it takes more dollars to buy that house now. So it's not, people always blame the housing market and it's, housing's getting crazy. Like, look at the dollar. It's actually the dollar that's just being devalued from all this money that's getting printed and getting passed on to the consumer in inflation. So, so by putting it in land, you are capitalizing on the devaluation of the dollar, just like you would with gold. Now, with land, you get a little more upside because you have the ability to leverage it. And that's why we do real estate and why we're able to, 10x our returns on some of these holdings, because we're using the bank's money and not our money to do this. So there's still more risk than there is with gold. You still have expenses. You have capex, so capital expenditures like a roof. So you got to figure those things out. You're paying interest on it, but it's also generating income, whereas you don't get that from gold. So if you're renting like a rental property, you're renting it and it's generating income. It's helping cover those costs.
Gold can just be sitting there.
And with gold's just sitting there. But with the ability to leverage, so for example, let's say you put $100 into gold, and after a high inflation period, it goes up to $130. So you made $30. With property, your $100, you put $100 down, and then you can buy $1,000 worth of property. And so when that goes up in that inflation period, the same amount of inflation, instead of your $100 being worth $130, going up the same ratio that the gold did, it's worth $1,300. So because it was, you turned and now the increase on that was $300 from the original $1,000 property that you purchased by leveraging it. So in the gold example, your $100 made $30, but in the land example, your $100 makes you $300 because you're leveraging it and you're able to take advantage of the leverage and multiplying your returns.
Okay.
So that's why I'm such a big proponent of land, because you can leverage it and you can 10x those returns with that leverage.
That makes sense. Do you feel like it's a good idea to build up cash reserves?
So I think yes, to a certain degree. I wish we had more cash reserves right now, because we've kind of depleted all of our cash reserves, and with these projects, we've kind of ended up carrying these properties that we're working on longer than expected, and between that and the economy going down and losing our income, it's definitely put us in a tough position. And we had cash and credit lines and things to pull on, but we've kind of depleted most of that just from this last year. So yeah, there's definitely having cash on hand is huge and can definitely help you through situations. But at the same time, you don't want to have too much cash.
To where it's not working for you, or just...
No. So what I mean by that is you want to make sure you have enough to get through hard times. If you lose your job or if it's just a down economy, whatever, you want to make sure you've got enough to get you through. But you don't want to put all your money in cash, because in a high inflation period, what happens to your dollar?
The value goes down.
The value goes down. So if you got $1 million in cash sitting in the bank, let's say in a couple of years ago, 2022, you had $1 million in cash in the bank, and you just put it in the bank. You're like, I'm just going to sit on the sidelines. I'm going to wait for this all to pass, and then, wait for a good time to get into the market or buy a property or put it into gold or whatever. By doing that and using our example here with the 130, if you did that, your $1 million is now only worth $770,000. You just lost almost $250,000 in value.
Pretty crazy.
Of how far that $1 million goes, because it was just sitting in the US dollar, which was just being devalued while the government was printing money.
So if you win the lottery, don't just put it in the bank.
Don't just put it in the bank. Put it in gold.
Do something smart with it.
Put it in gold, put it in land. Yeah.
Yeah.
So yes, you should have cash reserves, but enough to get you through. You don't want to have too much cash reserves, because you actually end up losing
Yeah, that's
money. You're getting a negative return on it because as the inflation is occurring, you're actually just it's not just $1 million. It's still $1 million, but that $1 million is not really worth $1 million anymore. It doesn't go as far. So you actually just lost money, or not money, I should say, but you just lost value, and the return on your investment sitting there, even though it's the same dollar amount. And so you're like, oh, it's a zero return, zero negative, zero positive. Well, it's actually negative now because it's been devalued so much.
So then, okay, value aside, I feel like this is why you hear people that have cash just like under mattresses and hidden in their house. Like a lot of people wonder how safe their money is in a bank. Like what did we talk about that at all?
Yeah. So, okay. So we're jumping ahead a little bit. So let's go back to putting money in the bank.
Okay.
If you're going to just sit on cash and you don't want to put money in real estate because you don't like real estate, or you don't want to deal with it, or you've had a bad experience, whatever, and you don't want to put it in gold or anything else, and let's just say you just want to keep cash and you want to ride through the economy, whatever, and have cash, instead of just putting money in the bank as a cash deposit, what you should do is do something that offsets the inflation. So you put it into a high yield savings account, which high yield savings accounts are paying like 5%, 5.5% right now, which is really high for a savings account. But you can get a high yield savings account and it's still cash. You can still withdraw it, but it's not like your in and out checking account like you would on a daily basis. But you're putting it in there with the intention of leaving it in there for a little longer, but you're getting a really high. And I'm not sure what all the ins and outs are and how, like, when you can pull the money out, or how,
like a time limit.
Yeah, I'm not real sure because we don't have one.
Yeah.
But a high yield savings account right now will help offset the inflation. So at the end of the day, hopefully after that high inflation period, your money has grown. And so maybe now your $1 million is now 1.3 million. So it caught up, it kept up with inflation. So you actually you're still at a net zero because of inflation. That, your 1.3 million is the same value, same intrinsic value that it was before, but it at least keeps up with inflation and you're not losing value and going backwards. There's other ways of doing that. You can also put into CDs, and that actually ties your money up. Usually CDs are like 6 months or 12 months and you can't pull the money back out, but they have those higher rates as well. And there's also bonds and other things that will keep up with inflation, or at least offset and hedge against that inflation. So I would definitely say don't just have it sitting in cash. That's not a good idea, especially during an inflation period like that.
Okay.
And this is why you hear like other countries. I've never heard this in the US, but I've heard this in other countries, like China, for example. Chinese investors will invest in investments or in bonds or things that have a negative return. So they'll put $1 million into a bond that has a negative 1% return, which seems crazy. Like, why would you do that?
Yeah.
But it's because their currency is, during a high inflation period, is devaluing so fast that they're happy to take a negative 1% return.
Wow. Because
it's actually better than keeping money in cash, because they might lose if their currency devalues 30% over a couple of years. The 1% sounds pretty good. So,
okay, that's true.
So it actually gives them the ability to put their money somewhere safer,
protect it a little bit better.
Versus devaluing so much.
Wow. Okay, that's interesting.
So let's say back to your question about how safe is putting your money in the bank. So putting value aside, let's just say you're putting money in the bank, and all the big banks, most credit unions, like they're all FDIC insured. So you'll see when you go to the counter, it says FDIC insured, and I think it even says like deposits up to $250,000.
Yeah.
So what that is that's federal insurance on the money that you're putting in the bank, and the government's just basically saying, hey, your money that you're putting into the bank is insured, and if something happens, we're going to make sure you get your money back. So if there's a run on the bank and the bank goes out of business or whatever happens, that's just ensuring that you're going to be able to get your money back. And each bank's up to $250,000. So if you have more than $250,000 in one bank, you're at risk because you're only insured up to the $250,000. So
if you spread it out between banks,
you can spread it out
at each bank.
Yeah, so you put $250 in Chase, $250 in Wells Fargo. Okay. So if you have that much money in cash, spread it out over different banks.
Yeah.
So that way you're getting the insurance protection on all your money. But so here's the thing that people don't know, and I didn't know this either until this book exposed this. The FDIC insurance does not protect everyone at the same time. It's the same thing with home insurance carriers, car insurance carriers. The carriers don't bet on everyone getting into a car accident on the same day. That obviously just doesn't happen. Mm-hmm. And that's how insurance works. So they're collecting premiums every single day, but not everybody's submitting claims every single day.
Okay.
So they've got formulas figured out like, okay, this is how many claims per day that we're going to see. This is what we're charging premiums. Their premiums, there's a delta. Their premiums are higher than what they're paying out on the daily claims.
Okay.
Same with house insurance. Until there's a fire or something that comes through, and then usually they get bailed out when that happens.
Yeah.
And then we print money and then to bail them out and then devalue the dollar even more. Yeah. And then we all pay for it. So basically that is how the FDIC insurance also works, is that they only have enough in the fund. So it's a fund. They've got cash reserves to be able to pay out claims if something happens, if the bank does go out of business. But they only have enough to pay out like 7% of all insured deposits.
Across all banks.
Yes. So
if there was like some sort of...
So if something big happened
like on 0 day.
What does... Yeah.
We're watching 0 day right now.
Yeah. Yeah, exactly.
I mean, that's basically what they talk about.
So basically this book is saying that they only have enough, with the fund that they have would only have enough to cover a couple banks.
That's scary.
Going out at the same time.
Really
so if there's a run on a couple banks, that's it. If there's a run on like 3 or 4 banks, FDIC would probably not be able to cover it, and then that would fail. And then when that fails, the entire system fails. Because then everybody's going to want to get their money out, but there's not enough money. And then here's the other crazy thing with banks. Banks don't have your money. So banks take deposits from everybody.
Okay.
So let's say they get, a bank is holding $1 million in cash from different people that deposit it. So just use a small number here to keep it easy. So they've got $1 million in cash from all their customers that have deposited money. So what the bank does with that money is they turn around, they lend it out, and do car loans, house loans, whatever. But they're not lending out $1 million. Well, okay, so first of all, let's say they do lend out $1 million. What happens when all those people that have the deposits come in to get their money and say, I want my money?
There's nothing there.
That $1 million isn't there because it's been lent out. The crazy thing is that banks don't just lend out $1 million because they work just like an insurance company does, and they are betting that not everybody's going to want their money out on the same day. So they will actually lend out that $1 million 10 times.
This is fascinating to me.
So whatever the ratio is that they've figured out, like they will lend it out that many times. So it's not lent out to one person, it's lent out to 8 or 9 different people. And so they're like way overextended on the lending that they're doing, because that's how banks make money. Because now they're making money
on all of those 10.
On all of the, yeah.
Yeah.
And they're able to lend it out without having it because everything is
backed and insured.
No, because it's not, they're not giving out the actual cash out.
Yeah.
Or they are, but it's all digital now. They're not actually giving people cash to go buy the car. It's all they just wire it over. But they've also got incoming wires because other banks are doing the same thing. So it's all this just cash flow just constantly circulating. And so it balances itself out enough to where they're able to just keep lending this money out that doesn't really exist. And they're just making money out of nothing. That money doesn't actually ever come back in until the loan gets paid off from whoever took out that loan. So it's all this fabricated it's basically printing money on the bank's end too, because it's all just fabricated and these loans are coming out of thin air. So, and they're only backed by the $1 million. So if they're lending that out 10 times, they've only got 10% of what's being lent out in actual cash reserves from the people that originally deposited
if something
it.
big did happen, like legitimately is people are just losing, their money's gone.
Yeah. I mean, if 10% of Americans all went out and said we want our money and all pulled out their cash, that would probably be catastrophic for the financial banking system.
That is so scary.
Yeah.
That's like really scary to think about, actually. Huh. Okay.
And the Federal Reserve's, their role in this is they're kind of the catalyst and the center of this whole banking system and everything that's going on. And the Federal Reserve is the one that makes the decisions on printing money and how how everything is orchestrated. And it was all started by this group of guys trying to basically create a monopoly in the banking system. It's fascinating seeing what the Federal Reserve is, this FDIC, like how all these banks operate, and all the banks that have failed and just get bailed out.
Mm-hmm.
And what happens when these countries have notes that because all these countries, the U.S. lends money to everybody.
Right.
We bail everybody out. And we do that by printing more money, and then we, as Americans, pay for it with inflation costs. But what happens is these different and banks have big loans keeping them afloat from bailouts or whatever it is. When they can't pay their loan, or a country can't pay their loan, it gets restructured and more money is given to them so that they can keep making the payments and keep the cash flow coming back in, and more money is printed, and it's just a big it's just a big Ponzi scheme basically. It's all this fake money being printed and created to keep the system flowing.
So crazy.
It is, and it's not something we can just explain in this one episode.
Yeah,
you kind of have to read the book and really go into it to really understand how everything is orchestrated and how it works. But it's crazy how fragile the system really is.
Yes.
Like,
so scary.
I mean, if you wouldn't even need everybody to pull their money out to just completely collapse the financial system. Which would be a really bad thing.
Yeah,
it would be really bad for everybody. But it's crazy how truly fragile.
Is that just a U.S. thing, or is that how it works pretty much everywhere?
Everywhere.
Oh, okay.
Yeah, all the governments are do the same thing.
Huh. Okay.
So that's why they say that how come if the U.S. is printing all this money and doing all this, how come the U.S. dollar is not just so devalued compared to everything else? And it's not worth if you look at the euro, it used to be pretty close. Now the euro is way stronger, but at the same time, all these other countries are doing the same thing. So they're kind of all leveling it out
when they're doing it. And
yeah. So all the governments are doing the same thing with their currencies. Okay. And what the book talks about, and I haven't finished the book, and it's kind of starting leading to this, is that all of this is pushing towards the New World Order, which I know you like to talk about. I don't want to make this a conspiracy podcast. I know you subscribe to conspiracytheory.com on some of your things, but the New World Order is definitely a real thing. It's
printed on the money.
It's definitely a real thing, and this book talks about everything that's leading up to that, and that it's going to be the fix, because it's basically.
So is
we've created such a big
conspiracy theorist?
No, but it's basically created such a big issue that it's going to need something.
That's the only way to fix it.
Yeah, because all these countries owe everybody money. It's going to get to where nobody can pay anybody. Everything's going to collapse. So it's basically kind of leading up to the New World Order is going to stabilize everything.
Interesting. So I'm not so crazy after all.
No, I never said you were crazy about the New World Order. I know, I know that, but what I didn't understand is why it was needed. Why, who would want that? Why would that be needed? And so this is leading into how that's coming about and what leads up to that.
Interesting.
Yeah. So
does it give a timeline of how many times this can happen, or can this be fixed and that not happen? Or is it just the inevitable? Or are you not there yet?
What do you mean? Wait, what do you mean?
Like,
Wh-
can instead of this being like a snowball effect and it leading to like a new world order, like, is there a way for the US to fix this system and like
I don't think
stabilize it
so,
more?
because I don't think it matters who's in power. I don't think anything matters, because the government is always going to keep printing money and just throwing money at things to fix things. Like even like the FDIC insurance. So let's say that fails and there's multiple banks that go out of business and it can't cover all the deposits. Like what's going to happen? Well, the US government's not going to let the whole economy just implode, because that would be bad for
Yeah.
everything. But they're just going to print more money and bail those banks out, bail everybody out, and then just more inflation, and just keep it and just
And
keep.
so at some point it's going to get to a point where they just can't do it anymore. Is that kind
Well,
of like
yeah, I think
what
you just devalue the dollar so much. It's like it doesn't like it you have to keep doing it more and more and more, and it just keeps like exponentially becoming a bigger problem. And so it's like a ticking time bomb. I think at some point you can only play that.
question is when?
You can only rob Peter to pay Paul so long before you just run out of Peters to rob. So yeah, that's but yeah, it's pretty scary at how volatile this system really is, and like how little it would take to just collapse everything.
So is like Bitcoin, is that the new currency that's coming? Or is it, do they talk about the currency or
there's something,
or what that?
I'm not real sure what Bitcoin's role in this is going to be. Bitcoin's still pretty new, and it's kind of unsure what its ultimate place
need to do like a
is
full
going to be.
episode on that. That's another one that's
Yeah.
a lot to dive into. I still have a hard time wrapping my mind around that.
Yeah, I think Bitcoin it's very volatile right now because it's new and there's a lot of speculation about Bitcoin on what it's going to be worth and all this and that. And so you see like these crazy numbers because of speculation. But the thing with Bitcoin is that unlike a government currency, you can't just print more. It has a finite amount. It has a fixed amount of Bitcoin in circulation, and that will never change. So as other currencies devalue, the price of Bitcoin increases because it doesn't change. So
it's kind of like the gold.
Kind of, but gold, you can mine more gold. You can't mine more Bitcoin.
Can you? I mean, at some point, the gold's going to be gone, right?
Well, we haven't gotten there yet, so they're still mining. They're mining more gold than ever. So you still are. It's keeping up with demand, but with Bitcoin, it's a fixed amount and it doesn't change. So there's only a certain amount of Bitcoin out there, and that's it. So you can't ever print more of it and cause inflation or devalue it, because that's not the way it works. And it's not owned by a government, so it's not managed by a government. It's
owned by like a person?
Not, it's decentralized. That's the whole point, is that nobody owns it.
How does that? Okay. Yeah. This is too much for my mind to wrap around at this time of night.
So I think as Bitcoin becomes more stable and as it becomes more mainstream, it'll stabilize. And I think it'll definitely have a place in the world economy. I don't know if it's going to be the one world money system that New World Order is going to use or whatever. I know there's something else called the BRICS. I think that there's like countries that were trying to create a one world money system. I don't know how that's going, but I don't know if it's going to be Bitcoin or not. But I think Bitcoin will always have a place because of the fact that it is decentralized and is not able to be manipulated and printed. You can't just keep making Bitcoin. So, but I think it'll stabilize at some point and not be so much speculation around it. It's kind of like a stock of a new like tech company or something. Like for example, like Tesla. 10 years ago, Tesla stock had a lot of value, but the company hadn't even returned a profit yet. The company was losing money.
People were just excited about.
People were excited about it. They're speculating, this company's going to be huge and yada, yada. And so it had this value based on nothing other than the technology and that this was going to be a big company someday. So it was all speculation. Now, if you look at it, the company is caught up with that speculation And so now it's a lot more stable than it was, because now it actually is turning a profit and actually is backed by something other than hopes and dreams. So I think like Bitcoin will get to that point and not be so volatile and up and down, because it'll be a lot more stable and it'll actually have a place in the world economy and be a little more stable. But it's just weird because Bitcoin's not backed by anything. Like it's not backed by gold. It's not backed by government. Weird. So it's like the fact that it has so much value is...
Well, and like who decides that there's just no more of it? Like who decided on the amount? That's what I don't...
There's this Japanese guy, I can't remember his name, who started Bitcoin.
So it was started by a person.
It was started by a person.
I mean, you say...
But it wasn't like he owned and controlled it. It was something that he couldn't control. It's decentralized.
So weird. It's just like out of a sci-fi movie.
Yeah. So anyway, I think that Bitcoin's probably a good place to start putting money. I wouldn't put all of it because you don't know. I mean, it's possible it could become worthless. You never know. But I think that I think a lot of cryptocurrencies will become worthless, but Bitcoin is probably the one that is the one to invest in, because it's tried. It was the first one. It's been tested. It's been around, and it's the way it's built. I think it's always probably going to have value. So what I'd like to do is actually start putting some money, some ESA money into Bitcoin and see where it goes, and maybe it'll pay for our kids' college. So I'm looking at setting up a Coverdale ESA, which is a educational savings account that you can do. It's a self-directed option, so you can put into things other than mutual funds. So we could put money into Bitcoin and just put it in there and see what happens. I'd also like to, once we have some of these properties in the 401k, some of these larger properties stabilized and start generating cash flow, I'd like to start dollar cost averaging into Bitcoin with that cash flow. So not taking the cash that we have now and putting into Bitcoin, but buying assets that are generating income and using that income to start building up a Bitcoin reserve and dollar cost averaging. Dollar cost averaging means that you're putting the same amount in each month, and so you're buying it when it's up, you're buying it when it's down, but overall you just keep buying at that same set amount each month, so that the cash flow from the property just keeps buying it. This is an idea that Michael Saylor introduced, and he's a big finance guy or a big Bitcoin person, and he was the co-founder of, I think it's MicroStrategies. I think it was MicroStrategies was the company that he started. But he actually came up with this program in conjunction with Grant Cardone. Well, Grant Cardone, I think, reached out to him, and Mike Saylor kind of put this together. And so what they did is they started a fund to buy real estate, buy a performing asset in a Class A apartment building, and using the cash flow from that property to just invest in Bitcoin. So instead of paying monthly dividends to the investors, they're just rolling that money back into Bitcoin. And so then everybody owns the real estate and the Bitcoin. So they're not buying Bitcoin per se, but the real estate is buying it for them.
Did you talk about that on a podcast? I feel like I heard that recently.
Yeah, he did. He's been pushing it a lot.
Okay.
Yeah. So I'd like to kind of start doing that on a smaller scale level, but at least starting to have some exposure in Bitcoin. I don't think putting all your money in one bet. Like, we have a lot in real estate, but I don't think doing that in something like Bitcoin is a great idea. It could be. It could pay off really good, but it also may not.
That's
so
pretty risky. Yeah.
It's pretty risky because it's so unknown right now. So I think like there's a lot of investors that are pretty bullish on Bitcoin. They're saying, I think the expectation overall is that over the next 10 years, it's going to 10x. It's worth about $100,000 right now. So the value of one Bitcoin is $100,000 right now, roughly. But I think the overall consensus is that over the next 10 years, it'll be worth $1 million. So if it 10x's, that's a pretty good return. But it's all speculation, so who knows?
Yeah.
But I think getting some exposure and putting some money in there, if we put it on these ESAs, these Coverdale ESAs, we can put $2,000 into the account per year per kid. So let's say over the next 5 years, we're able to put $2,000 in for each kid. And then, years 6 through 10, it ends up just going crazy and then does hit that $1 million. And the thing with Bitcoin is you don't have to buy one Bitcoin. You don't have to have $100,000 to buy Bitcoin. I
was going to say
no, it breaks down. It breaks down to like one. I don't know how much it breaks down, but like kind of like a dollar has pennies and breaks down. It breaks down way farther than pennies. It's like 1/1,000,000th of a Bitcoin or whatever. I mean, you can basically buy whatever amount that you want.
It's like, dang, all these people buying Bitcoin. Are they like?
Yeah, so you're just buying a fraction because it breaks down, so that you're not buying a whole Bitcoin.
Okay.
Yeah, so I think getting some exposure, that could be good, because I mean we might put in $8,000 to $10,000 over the next 4 or 5 years, and then by the time they go to college, it could pay for their entire college. Like I say, it goes up, and with the devaluation of the dollar, then maybe it's worth $100,000 when they're ready to go to college. Like, just paid for their school. We don't have to worry. It costs us $10,000 to. I'm sure school is going to be $100,000 pretty much anywhere you go by then. So
I think it's going to be $100,000 like a year at that point. That's what you meant, right?
Oh, I don't know. Well, then hopefully Bitcoin goes really crazy then.
I was like, I don't think your math is mathing right now.
Yeah, we'll see. Who knows? But so anyway, that's my closing remark as this book. So it's called The Creature from Jekyll Island. It sounds like a sci-fi or something almost, but it's basically these guys met in Jekyll Island and created the Federal Reserve, which is the creature. So, but yeah, The Creature from Jekyll Island, a second look at the Federal Reserve, and it's by G. Edward Griffin. So, great read. Okay. It's long. It's a little dry. Starts out a little dry. So you got to kind of get into it and get past the first few chapters. But once you start getting into it and you're just like, oh my goodness, this is crazy stuff.
Yeah.
Sounds it's good knowledge to have.
Yeah, definitely.
All right. Anything else?
I don't think so. That was a lot we talked about tonight.
Yeah. So, I mean, inflation's a real thing. I think it hits home right now because everybody's experiencing it. And, we just went through a high inflation period. Hopefully, I think inflation is definitely coming down now with the Fed lowering the interest rates. Or actually, I mean, I'm sorry, with them raising interest rates over the last few years, they've slowed down inflation, because that when you raise rates, it slows down money flow because people aren't buying as much, and so it slows down that circulation, which can kind of slow down the inflation. But yeah, so we'll see. And with the new White House, with Trump having Elon come in and creating the Department of Government Efficiency, which is something that's never been done. It's kind of crazy with how these contracts and all this stuff that they're canceling. Like, I don't know how that's going to affect the economy and inflation, because a lot of that money that was being printed is maybe, was going towards this stuff, and now it's getting canceled. So now that money is coming back in. So that could play a role too. I don't know. That's something that's never really happened before. The government's always just spend and print more to spend more.
Yeah.
We've never really like retracted and stopped
never like
spending.
A checks and balances kind of system.
Yeah. I mean, they're talking about being able to balance the budget in the 2 years that they're doing this program. And that's never,
crazy.
I feel like that's never happened. So I don't know. That could definitely play into inflation and bringing that way down. And so I don't know. We'll see what happens.
All right.
But that's it for me.
That is it for me, for sure.
That is definitely it for you.
Yeah.
All right, guys. Have a good night. Get out there and make it happen.
Thanks for listening. This has been a production of Rebuilding the Dream Studios.